Welcome to this session. So in the previous lecture, we have covered different components of bank's balance sheet, and we covered each and every component of bank's liability side, and then we started discussing bank's asset sides. So in the bank assets, we have covered reserves, securities, cash items in process of collection, and deposit other banks. So the remaining are loans and other assets. So coming to this first part, the loans, this is an important activity of a bank. So bank make their profits primarily by issuing loan. A loan is an asset for a bank because it provides income to the bank, and at the same time it is a liability for the individual or corporation receiving it. So typically a bank loan is less liquid than other assets because they cannot be turned into cash until the loan matures, and also have a higher probability of default than other assets. And because of their lack of liquidity and their higher default risk, the bank earns its highest return on loans. So this topic that when the risk is very high, we have covered in the previous sessions. That means higher the risk and higher will be the return normally for those who issue this kind of security, right. So because of that, banks earns its highest return on loans. And as we discussed in the previous session, that is there is interbank loans as well, and so these are all the components of loans in the asset side of bank balance sheet. And coming to other assets include the physical capital owned by banks and is included in the other assets category. The examples of other assets are mainly bank building, computers and other equipments. And yeah, so we have covered the different components of bank's balance sheet, the asset side and the liability side, and in this session we will be focusing now more on and how the basic banking. So this we will be explaining using a T account. And what's a T account means? A T account is a simplified balance sheet with the lines in the form of a T that lists only the changes that occur in the balance sheet items starting from some initial balance sheet positions. So using this T account, we will now start how a bank functions, what are the basics of banking. So let's start with different scenarios. One option here is that someone deposits some cash with a bank. Then how does the T account of a bank look like? So you just imagine, that means you deposited $100 with the bank. So in this scenario, what is going to happen? So how does the asset and liabilities of this T account changes? So you can notice from this table, that means the vault cash is increased to $100 and the vault cash is increased. But importantly, first we need to say somebody deposited this cash deposit, that the checkable deposit, so it's a liability. Immediately there will be an increase of $100 checkable deposit, that the liability for the bank, and same time this cash it is with the bank now is a vault cash, and this is how the T account of this bank change. That means the asset there is an increase of $100, and on the liability side also you can see the checkable deposit has increased by $100. So opening a checking account leads to an increase in the bank reserves equal to the increase in checkable deposits. And we are actually going to say that this vault cash, which I put assets here, actually later on we will study in detail. That means vault cash is also part of reserves. So you can now look at the bank's T account, it look like this. The assets, it became reserve increased by $100, and checkable deposit also increased by $100. This is scenario 1. And scenario 2, see that a bank is receiving a deposit, someone is depositing a check with a bank. So in this case, immediately how does the T account look like? So you can see that immediately on the asset side, you can see that the cash items in process of collection, cash items in process of collection, that means $100 it increases, and that means immediately this much amount it will be credited as a deposit in the name of the person who deposit this check. And you can also see that the liability of the bank also increases, liability of the bank also increases by $100. So what you can see here, that means when a bank receives additional deposits, it gains an equal amount of reserves. When it loses deposit, it loses an equal amount of reserves. So this one we convert again in the form of assets and liabilities. You can see that the cash items in process of collection, so subsequently is going to become reserves. When they get this money, this $100 become reserves for this bank. And it also, as we made shown in the previous table, that means it also become a liability. So the T account, what I am showing you here in the first table, immediately by someone depositing this check, here the asset and liabilities changes in this way, that means cash items in process of collection and checkable deposit. And subsequently this one will become reserves. When they collect this money, this will become reserves, and again this checkable deposit is already in their name, so in name of the depositor, so it will be checkable deposits. What would happen to the second bank who issued this check? So you can see that in their account they are actually losing $100, because the first table that we see, cash items in process of collection, once it is collected, this bank's reserve, the second bank who issued this check, their reserves decline by $100, and they also lose the checkable deposits of $100. So you know that all this transaction, it happens to the central bank through the Fed or through the RBI. So between these two banks actually who issued this check and with the bank where this was deposited, so all these transactions, it happened through the central bank. So now let us see that how does a bank make profit. By a very simple example illustration, we are going to show that how does a bank make profit. So you can see that in the case of the first bank, the reserves has increased by $100, and we also see that the liabilities has increased by $100. So for this bank, no point of keeping this money idle here, because you can see that this bank can invest this money elsewhere and make profit. And not only that, when someone is depositing this $100, this bank is liable to pay interest income and plus also incur other costs for in terms of servicing this deposit. So in this case, what this bank will do? So this bank, because we also seen that every bank, scheduled bank, when they get deposit, be it time deposit or demand deposit, they have to keep certain fraction of their deposit with the central bank. So in this case, assume that the required cash reserve ratio is 10%, suppose. In that case, what this bank will do? This bank, now let us see how does this bank's T account look like. So on the asset side, you can see that suppose if they have to keep 10%, that means they have to keep $10 with the central bank. So the remaining is $90. So for the moment, let us call it as excess reserve. Suppose they are not utilizing this money. So the moment they got the deposit, 10% they kept with the central bank. So the remaining one is excess reserve. And as we shown before, the liabilities is checkable deposit is remaining $100. So for a bank, because it's also a firm, it also want to make profit, they won't keep this excess reserve simply with the central bank. Instead, they prefer to employ this fund, and in order to, they will be lending this money, because this is a liability, liability they got through the checkable through the checkable deposit. Now we put it on the asset side, and now they will be utilizing, employing this money. How they will do? So let us take a very simple case. That means this bank is going to lend this money. Instead of keeping excess reserve, immediately they will be lending this money to someone. So in this process, you can also see that what we discuss here is that actually this bank got $100 deposits. Out of this 10% is kept with as a liquid reserve, and remaining 90 in this example illustration they gave it as loan. So this actually what the bank did here is nothing but asset transformation. That means selling liabilities, that the checkable deposit with one set of characteristics that we discussed previously, that the liquidity, risk, size and return. Now this one, using these proceeds they buy assets with different set of characteristics. This is nothing but loan. They are actually buying assets, that means loans they are buying, that means they are giving loans. So in this process this actually called the asset transformation, and in this process banks make profit. And you can also see here that this process, that means bank borrow short, because checkable deposit these are borrowing short because you can withdraw. Suppose if you the checkable deposit belong to you, you can withdraw at any time. That means bank is borrowing you for short term, and they then using this proceed bank will be lending it for long term. So this is how a simple way of to understand how a bank function. Let us now move to different aspects of bank functioning, and in this process, that the asset transformation and banks functioning, what are the various principles a bank need to take care of. So there are different principles, primarily 4 main principles. So we will be discussing these principles one by one. The first one is called liquidity management, and this is called means simply saying that actually ensuring enough ready cash with the bank. And then comes asset management, that means low rate of default risk. Then coming to liability management, that is called acquiring funds at low cost. Then the last one is capital adequacy management. And subsequently what we will also do that we will make some in-depth discussion of credit risk and interest rate risk as well. Okay. So now we are going to focus more on the first principle, that is called liquidity management. How does a bank ensure that what are the considerations a bank should do to ensure that there is enough ready cash with the banks. That means a depositors approach a bank for withdrawing a deposit. At that time there should be sufficient fund with the banks in order to honor the depositors withdrawal request. So that is our focus now. So liquidity management, suppose when there is a sudden outflow of deposits, at that time how does a bank ensure there is sufficient fund or liquidity is there. And this we are actually seeing that how do a bank ensure sufficient liquidity with the bank. And in this case we discuss various scenario in which a bank can ensure that there is sufficient liquidity. So let us first look into the role of reserves in ensuring liquidity management. So look at this table, what you can see here that how does this bank's balance sheet look like. So on the asset side we have mentioned reserves worth 20 million. And loans worth 80 million, securities worth 10 million. Securities means investment in bonds, government securities, etc. And on the liability side, they have a deposits of 100 million and bank capital is 10 million. And here as per law, as per the central bank requirement, the required reserve ratio is, for example, 10% only. So, if 10% is the required reserve ratio, and you know that 10 million is the deposit with this bank, you know the 10% of this one, actually the bank is required to keep only 10 million, only 10 million it is required to keep CRR. But what the bank has done here? So, here the bank has kept 20 million, that means 10 million in excess. And you know that when bank is keeping excess reserve, actually bank is keeping excess reserve of 10 million. And obviously you know that when bank is keeping excess reserve, actually they are foregoing interest income. Actually they could have utilized this money for making other investment, giving loan or making any other kind of investment. But instead this bank is keeping 20 million, and loans they have given only 80 million, and securities they invested only 10 million. And in this case, what is going to happen if suppose if there is a sudden deposit outflow of 10 million, for example. So, in this case what is going to happen? So, you know that if there is a sudden deposit outflow of 10 million, obviously you know that this one will come down, because here we have seen that 10 million outflow has happened, 10 million of deposit outflow has happened. So, as a result the remaining deposit is only 90 million. So, how do this bank honor this sudden deposit outflow of 10 million? So, because you see that immediately they can take it from the excess reserve. Excess reserve, it may be kept with the central bank or in the form of vault cash. So, this 10 million they will be taking it from from here, this excess reserve, then the reserve now declined to 10 million, right. So, you can see here that actually now in the new scenario the loans, because loan they did not touch, because we cannot, a bank cannot call back a loan easily, and securities also they did not touch. What this bank has done, that in order to meet this sudden deposit outflow, they have taken money from this excess reserve. So, now because deposit has come down to 90 million, and you know the 10% of 90 million they have to keep only 9 million only, right. Again there is some $1 million excess reserve is there. So, this is one scenario, that means keeping excess reserve. If a bank has ample excess reserve, a deposit outflow does not necessitate changes in other parts of its balance sheet. So, they can easily honor the withdrawal request from depositors, they can easily give. However, in the subsequent next session we will be covering, it has some cost, some opportunity cost, mainly because keeping money in excess reserve there is an opportunity cost of foregoing income, that means foregoing investment of this fund, that opportunity cost is there. But for the moment we are just focusing on liquidity management, then saying that keeping excess reserve, it works as a cushion against sudden deposit outflow. And suppose take another scenario, polar opposite scenario, that means there is no excess reserve at all. So, look at this bank balance sheet, again we have deposits of 100 million, and obviously you know that if the 10% is the required reserve, they have to keep $10 million as reserve. This is actually CRR, cash reserve requirement is 10 million, they are keeping 10 million there as excess reserve. And again what we discussed previously, shown previously, 90 million as loans, securities as 10 million. So, in this scenario, suppose there is a sudden deposit outflow of 10 million, what will this bank do? So, you can see that now anyway they have to give 10 million, immediately they will be giving 10 million from the reserve, they have the required reserve, that is with the central bank, right. This money with the central bank as the deposit, and immediately they will be taking that money and giving to the depositor when he comes to the bank, approach the bank for deposit withdrawal. So, you can see that reserve has now become 0, because you see, this is actually a legal requirement, the shortfall must be eliminated. So there are certain instructions that instructions are there, requirements are there. At the end of the business day, this 10% reserve requirement should be with the central bank. But now this bank, they don't have any other option from this example. They have to take immediately this reserve. Using that, the bank is giving honoring the $10 million withdrawal. Now you can see that the depositors come down to 90 million, and now they have to keep 9 million as 9 million they have to keep as required reserve, but the moment they have 0 reserve. So you can see that this is 1. So that in that way, what we have shown here is that excess reserve they have to keep, normally banks keep as an insurance against the cost associated with the deposit outflow. So how to manage this situation? This situation how to manage? Because you know that bank they have to keep 90 million they have to keep, because this previous scenario, this 0, this is not acceptable. They have to keep 10%, that the 9 million they have to keep. So in order to do that, reserve, one option is bank will be borrowing. Bank will borrow from other banks or borrow from the central bank itself. That is one option. So what are the costs involved? So that as a result, you know that the required reserve, that the 10%, that the 9 million it compensated, it actually raised this much fund from through borrowing. That is one option. And you know what is the cost incurred? Cost incurred is the interest rate, that interest income paid on the borrowed funds, right? So that is one cost included. Option number 2, look at these securities. They are keeping 9 million as the securities, government bonds suppose, and what they can do, they can sell it and get 9 million, and using that now they can meet the reserve requirement. And however, the cost of selling securities is the brokerage and other transaction costs, plus what is the ongoing market price of the security. They have to sell at the given market price, right? So maybe at that time, maybe the security price may be low, maybe in that way, maybe the bank may be incurring some losses. Third option is to borrow from Federal Reserve, that means borrowing from the central bank. So in this case, you can see that this 9 million they are getting it from borrowing from the Fed or borrowing from the central bank. That is in the case of RBI in Indian case. And again, you can see that borrowing from the Fed, it also incurs interest payments based on the discount rate. This is the third option for borrowing for this bank. And the fourth option, you can now see that initially we have seen that this bank is having 90 million as the loan, 90 million as the loan in their asset side. Now the fourth option is that, because in order to get this 9 million, bank has to, one option is that bank can call back 9 million from their loan portfolio. That is one option. However, you know that is not so easy. That means the bank has given loan to business firms, government and consumers, maybe education loan, and in order to purchase consumer durables and all. So now the government, this bank is facing an emergency to meet a liquidity issue, to meet fund scarcity, to meet the liquidity requirement. Suppose if they do or raise this fund by calling back 9 million loan, maybe one option calling back, or otherwise if there is a loan already due for renewal, bank won't be renewing it. In this scenario, you know that bank can do, but actually reduction of loans is the most costly way of acquiring resource. You know why? Because calling in loans antagonizes customers. And not only that, it's not guaranteed that you can call, because loans are given on an agreement, right? There is a term will be there, maybe 1 year or 5 year or 10 years like that. So at that time a bank cannot easily call back the loans for its purpose in order to meet the reserve requirement. It will antagonizes the customers. And similarly, if they are not renewing the loan, suppose the bank is not renewing the loan, it actually affects the loyal customers, because customers having a trust on their banks. That means when they make timely repayment of their loan, it will be automatically renewed, right? A guaranteed renewal is there. But if bank works against this, and that also further antagonizes the customers. And the second option is loan resale. Loan resale, that means resale of this loan. But you know that again this is a costly proposition, because other banks may only agree to purchase the loans at a substantial discount, right? So this is also has its own cost and its own demerits as well. So the topics that we have covered so far is the liquidity management, and now next part of bank management principle is the asset management. So we will be discussing here what are the different principles or aspects involved in the asset management. And mainly a bank, when is acquiring more assets, it will be keeping three goals in mind. One is it would like to earn highest possible return on assets. That means suppose a loan is an asset. So in that case the bank would like to earn highest possible return on their assets. And bank also want to reduce risk, the default risk they want to reduce. And it also need to ensure that it has adequate liquidity with the bank. The assets that they are acquiring, it is actually sufficient liquidity is also involved with that. These are the three goals. So in order to, in this process they use mainly 4 tools. One is find borrowers who will pay high interest rates and have low possibility of defaulting. And second tool is purchase securities with high returns and low risk. Third tool is lower risk by diversifying, that means not putting all eggs in one basket. And the last tool is balancing the need for liquidity versus increased returns from less liquid assets, so that it can satisfy the cash requirement without bearing huge costs. Okay. So in the next session we will cover the liability management aspects. Thank you.